Disclaimer.
March 11th, 2026. Now, right now, as you're watching this video, the dollar still dominates global oil trade. But the system that guaranteed that dominance for the last 50 years, the invisible architecture propping up every dollar in your wallet, your savings account, your retirement fund, that system no longer exists. It ended quietly. June 9th, 2024. No emergency press conference, no breaking news, Kyron. Not a single mainstream financial channel interrupted their regularly scheduled programming to tell you that the deal holding the entire dollar system together had simply expired. Wasn't renewed, wasn't replaced, just gone. And here's what should genuinely concern every one of us. Most Americans still have no idea this happened. Not because they aren't paying attention, but because nobody told them. Not their broker, not their financial advisor, not their newsfeed. So I'm going to tell you. Because to understand what changed on that quiet Sunday in June 2024, you first need to know what was secretly built 50 years earlier. A deal your own government hid from you for 4 decades, that most of Congress never knew existed, and that was the single most important reason the entire world still holds American dollars. This is where our story really begins. Cast your mind back to August 15th, 1971. President Richard Nixon walks into a television studio and delivers what sounds like a routine economic update. But buried inside that broadcast is a decision that should have ended the dollar's reign as the world's reserve currency right then and there. Nixon announces that the United States is suspending the convertibility of dollars into gold. Just like that, the Bretton Woods Agreement, the post-World War II framework that gave every nation on earth confidence that their dollar reserves were backed by something real and physical sitting in Fort Knox, is finished. Think about what that actually means for a second. Every other country in the world had agreed to hold dollars precisely because those dollars were redeemable for gold at a fixed rate. America essentially made a promise to the planet. Give us your goods, your oil, your labor, and we'll give you dollars you can always trade back for gold. Nixon just broke that promise. Unilaterally, on television, the dollar should have collapsed. Global confidence should have evaporated. Foreign central banks should have dumped their reserves and demanded something, anything, more trustworthy. But that didn't happen. And the reason it didn't happen is a story that the State Department successfully kept classified for 40 years. Here's what very few people know even today. In the chaos following Nixon's announcement, a small team of Treasury officials and national security advisors began working on an emergency replacement for gold, something that could anchor the dollar's global value without requiring America to hold the physical metal. What they landed on was elegant in its simplicity and breathtaking in its audacity. They decided to back the dollar not with gold, but with oil, and specifically with Saudi oil. In 1974, Treasury Secretary William Simon and a senior State Department team quietly flew to Riyadh. What they negotiated over the course of those meetings was never put to a congressional vote, never debated publicly, and never disclosed to the American people. It was a bilateral arrangement operating in the shadows of normal diplomacy, and it worked so effectively for so long that most of the world simply accepted its consequences as natural law. The deal Bloomberg's investigative reporters finally unearthed through a Freedom of Information Act request in 2016, after 40 years of classification, had 3 interlocking parts. And understanding all 3 is essential because the entire structure only holds if every piece remains in place simultaneously. The first part was pricing. Saudi Arabia agreed that all of its oil exports, every barrel to every nation on the planet, would be denominated exclusively in US dollars. Not yen, not Deutsche Marks, not British pounds, dollars. This meant that Japan needed dollars to buy Saudi oil. Germany needed dollars. India needed dollars. Every industrialized economy on Earth suddenly had a structural, permanent reason to hold large reserves of American currency. The dollar didn't need gold anymore. It had something better, an energy commodity that every modern economy absolutely could not function without. You want to understand why the dollar stayed powerful after Nixon broke the gold promise? That's why. The world didn't choose to keep using dollars because they trusted American monetary policy. They kept using dollars because they had no choice if they wanted to keep their lights on and their factories running. The second part of the deal was what economists call petrodollar recycling. And this is the mechanism most people miss entirely, even the ones who've heard the basic story. When Saudi Arabia collected all those dollars from global oil sales, they didn't just sit on the cash. They were directed, as part of the arrangement, to reinvest a substantial portion of those earnings back into U.S. Treasury bonds. Saudi oil wealth flowed out of the ground in the Arabian desert, got converted into dollars at the point of sale, and then came right back to Washington as a loan to the U.S. government. Pop quiz. Have you ever wondered how America managed to run enormous budget deficits for decades without triggering a debt crisis? How we could spend more than we collected in taxes, year after year, and still borrow at relatively low interest rates? This is a significant part of the answer. The petrodollar recycling system created a captive buyer for American government debt. Saudi Arabia, and by extension the broader Gulf state network that followed their lead, became permanent, reliable purchasers of the bonds that financed American government spending. It was, to put it plainly, one of the most elegant financial arrangements in modern history. The third leg was the one that made everything else credible: American military protection. The United States extended a formal security guarantee to the Saudi kingdom. American naval assets protected the Persian Gulf shipping lanes. American military advisors trained Saudi forces. American diplomatic cover shielded the royal family from international pressure. In exchange for keeping oil priced in dollars and recycling petrodollar revenues back into treasuries, Washington became Riyadh's ultimate security guarantor. Remove any one of those three legs, and the entire structure becomes unstable. Remove all three, and you have exactly what we're living through right now. Because here's the part that changes everything for your financial life, and the part I want you to sit with for a moment before we go any further. That arrangement, the one negotiated in secret in 1974, the one that replaced gold with oil as the dollar's anchor, the one that financed decades of American government borrowing, the one that forced every economy on the planet to accumulate dollar reserves, that arrangement came with a formal 50-year term, 50 years from 1974, which brings us back to June 9th, 2024. The day the deal expired, Saudi Arabia made a choice that almost no American financial media outlet stopped to explain clearly. They chose not to renew, not to walk away dramatically or announce a new alliance, just quietly, legally, to let the formal arrangement lapse. And with that lapse came something with enormous consequences for our economy. Saudi Arabia gained the legal freedom to price and accept payment for its oil in Chinese yuan, in euros, in Indian rupees, in whatever currency a buyer brings to the table. For 50 years, that was not an option. Now it is. Think about what that means for the dollar's position in the world. Think about what it means for every savings account, every treasury bond, every dollar-denominated retirement account sitting in households across this country. The invisible foundation that made the dollar indispensable to the global economy, not because of American virtue or economic superiority, but because of a secret deal made in a desert kingdom. That foundation just became optional. And what happens next is already unfolding in ways that most of the financial press still isn't connecting to your daily life. The evidence is sitting in plain sight, in reports from institutions like the Bank for International Settlements, in central bank purchase records from the World Gold Council, in the trade agreements being quietly signed while our attention is elsewhere. The architecture being built to replace what expired in June 2024 is not theoretical. It's not a plan for some distant future. It is operational, it is accelerating, and the window to position yourself ahead of it is narrowing faster than most people realize. Most financial conversations about dollar decline get stuck in the theoretical. Experts debate whether it could happen. They model scenarios for 10 or 20 years from now. They reassure audiences that the dollar is still dominant, which is technically true, while quietly ignoring the fact that the infrastructure to replace it is no longer a blueprint. It has already been built, tested, and switched on. Let me show you exactly what I mean. And I want you to pay close attention here, because these are not predictions. Every single thing I'm about to describe is documented, sourced, and already in motion. Start with a platform most Americans have never heard of, because the financial press treated it like a minor technical footnote when it deserved front-page coverage. It's called mBridge, and in June 2024, the same month the petrodollar agreement expired, Saudi Arabia formally joined it. Here's what mBridge actually is, stripped of the technical language. It's a digital payment system developed initially with China, the UAE, and Thailand, specifically designed to settle international transactions, including oil payments, completely outside the SWIFT network. SWIFT, for those who aren't familiar, is the backbone of international dollar transactions. It's the system that processes the wire transfers, the currency conversions, the cross-border payments that make global trade run. And critically, it's the system that gives Washington enormous leverage over the global financial system, because anyone cut off from SWIFT effectively can't participate in international commerce. When Russia was sanctioned in 2022, the United States and its allies weaponized SWIFT access to isolate the Russian economy. It was a powerful move, but it was also a demonstration that taught every non-Western nation watching exactly how exposed they were. If Washington could flip a switch and cut Russia off from the global payment system, what was to stop them from doing the same to China, to India, to any country that disagreed with American foreign policy at a critical moment? mBridge was the answer those countries built. A parallel payment rail running alongside SWIFT rather than through it, where oil and commodities could be bought and sold in whatever currency the parties agreed on, with zero exposure to American financial oversight or sanctions authority. And now, Saudi Arabia, the kingdom whose 1974 agreement made the dollar-oil link official, is a full participant. But here's where the story gets genuinely alarming in a way that almost nobody reported. In October 2024, the Bank for International Settlements, the Swiss institution often called the central bank of central banks, the organization that had been quietly helping develop BRICS for years, announced it was exiting the project, walking away entirely. Think carefully about what that signals. The BIS doesn't make dramatic exits from projects without reason. Their departure effectively handed full operational control of BRICS to China, leaving the platform running as a Beijing-led settlement system with no Western institution inside it, no Western oversight, and no Western veto over how it evolves. The BIS exit wasn't a warning that BRICS was failing. It was an acknowledgement that the platform had outgrown the fiction that it was a neutral multilateral project, and that what remained was something Western financial institutions couldn't put their name on. Saudi Arabia stayed. The yuan-denominated oil payment infrastructure is live. That's not a forecast. That's a fact. Now, layer on top of that what's been happening in the gold market, because this is the second stream of evidence that something structural has shifted. And the numbers here are genuinely staggering when you understand what they represent. According to World Gold Council data, global central banks purchased over 1,000 tons of gold in 2022. Then they did it again in 2023, then again in 2024. 3 consecutive years of central bank gold buying at a scale that has never happened before in the recorded history of modern monetary policy. To put that in perspective, in the decades before 2022, central banks were often net sellers of gold. The conventional wisdom among reserve managers was that gold was an outdated, non-yielding asset that took up space in a modern portfolio. Dollars and treasuries were the sophisticated choice. Something changed that thinking dramatically. And it didn't change for one country. It changed simultaneously for central banks across Asia, the Middle East, Eastern Europe, and Latin America. The World Gold Council's surveys consistently show the same reason near the top of their list: concerns about sanctions risk and dollar dependency. In plain language, these institutions watched what happened to Russia's reserves in 2022, roughly $300 billion in dollar-denominated assets frozen overnight, and made a quiet, collective decision to hold something that no government on earth can freeze with a phone call. Gold can't be sanctioned. It can't be blocked from SWIFT. It can't be devalued by another country's monetary policy decision. And right now, the world's central banks are accumulating it at a pace that is physically absorbing more than 20% of annual global gold supply every single year. Then, in December 2025, the next piece landed. BRICS, the economic bloc comprising Brazil, Russia, India, China, South Africa, and now several additional member nations, launched a pilot settlement instrument they're calling the unit. This isn't a cryptocurrency. It isn't a single national currency being promoted as a replacement. It's a basket-based settlement tool, and here's the detail that connects directly to everything we've been discussing. The unit is backed 40% by gold. Let that sink in for a moment. The bloc representing roughly 40% of global GDP has introduced a trade settlement instrument with a hard gold anchor at precisely the moment when their central banks have been accumulating gold at record pace, at precisely the moment when they've built a payment system that bypasses SWIFT, at precisely the moment when the 50-year petrodollar agreement has lapsed. These are not coincidences. This is a coordinated architectural shift that has been years in the planning, and the pieces are now snapping into place in public view. Now, I want to address something that a lot of viewers are probably thinking, because it's the most common counter-argument to everything I've just laid out. And honestly, it's a fair point on its surface, until you examine the unintended consequences. The counter-argument goes like this: Washington isn't sitting still. The Trump administration has made it abundantly clear that any nation pursuing a dollar alternative faces severe economic consequences. In early 2025, the White House threatened 100% tariffs on any BRICS member country that moved forward with a dollar replacement currency or settlement system. It was a forceful message, delivered loudly and unmistakably. Here's the problem, and this is the part that I find genuinely fascinating from a strategic standpoint, because it's so counterintuitive it almost sounds like something out of a geopolitical thriller. The threat itself, and the very act of saying, use our dollar or face economic punishment, is precisely the argument that BRICS has been making to recruit new members for years. Every time Washington demonstrates that dollar access can be weaponized, every time a tariff threat lands on a developing nation's finance ministry, it validates the case that dollar dependence isn't a neutral feature of the global financial system. It's a leverage tool. It's a weapon aimed at anyone who steps out of line. Brazil's finance ministry officials have said it openly. Indian economists have published papers on it. Gulf state advisors have whispered it in conference rooms. The message landing in capitals from Riyadh to Jakarta to Sao Paulo isn't America is strong. It's America is scared. And scared powers don't make their partners feel safe. They make them look for exits. The sanctions strategy that neutralized Russia's dollar reserves in 2022 didn't just punish Russia. It advertised to every other major economy exactly what holding dollar reserves actually means in a crisis. And the BRICS memberships, the gold purchases, the BRICS settlement pilots, Those are the direct documented responses from countries that received that advertisement and drew their own conclusions. What we are watching is not a sudden dollar collapse. It is something more insidious and, for everyday Americans, potentially more consequential. A slow, deliberate, systematic reduction in the structural demand for dollars, built brick by brick, payment rail by payment rail, gold ton by gold ton. And the mathematical consequences of that shift for your savings, your purchasing power, and your retirement are what we need to talk about next. Because when you run the actual numbers, and I mean the specific figures sitting in Federal Reserve reports and JP Morgan research, what comes out on the other side is not an abstract geopolitical concern. It's a personal wealth calculation that every American deserves to understand before the mainstream press finally decides to call it settled fact. Let me make this personal for a moment. Picture someone we'll call David. He's 54, lives outside Columbus, Ohio, spent 30 years working in manufacturing, and has about $280,000 sitting in a mix of treasury bonds and a 401k that's heavily weighted toward dollar-denominated assets. He checks his balance periodically, feels reasonably secure, and assumes that because nothing dramatic has happened yet, nothing dramatic is coming. David is not careless. He's not uninformed. He's just operating on a mental model of how the dollar works that was accurate in 1995 and is quietly becoming less accurate every single year. Not because of anything David did wrong, but because the geopolitical architecture underpinning his savings is being rewired beneath him while financial media discusses quarterly earnings and Fed rate decisions. What I want to do right now is show David, and every person watching this who sees a little of themselves in that description, exactly what the math looks like when you trace the petrodollar unraveling all the way to your personal balance sheet. Because it's not complicated once you see the chain clearly. Start with U.S. government debt. As of early 2026, the federal government carries approximately $36 trillion in outstanding debt obligations. That number is important. What's equally important, and far less discussed, is the interest rate at which that debt is financed, because that rate is not fixed. It moves with global demand for treasury bonds. And global demand for treasury bonds is directly tied to how many dollars foreign nations need to hold in reserve. Here's the chain. When oil is priced exclusively in dollars, every oil importing nation must maintain substantial dollar reserves. Those reserves don't sit idle. They get invested in the safest, most liquid dollar asset available, which is U.S. Treasury bonds. That permanent structural demand from foreign central banks and sovereign wealth funds is what has historically kept Treasury yields, and therefore U.S. borrowing costs, lower than they would otherwise be in a free market. Now run that logic in reverse. Every 1% of global oil trade that shifts away from dollar settlement is 1% less structural demand for treasury bonds from foreign reserve managers. And on $36 trillion in debt, even a seemingly modest rise in borrowing costs, say half a percentage point, translates to an additional $180 billion in annual interest payments that American taxpayers are on the hook for every single year, compounding, with no ceiling in sight, because the debt itself keeps growing. Federal Reserve analysis has consistently identified foreign official demand as a meaningful suppressor of long-term Treasury yields. The Bank for International Settlements has published research connecting reserve currency status to borrowing cost advantages worth tens of basis points annually. This isn't fringe economics, it's mainstream institutional analysis that simply hasn't been translated into language that connects to David in Columbus and what happens to his cost of living, his mortgage rate, and the purchasing power of his retirement savings. The honest answer to what happens when that structural demand erodes is everything gets more expensive for ordinary Americans. The government borrows at higher rates, which means more of the federal budget goes to interest payments instead of services or investment. Higher Treasury yields ripple into mortgage rates, car loan rates, business borrowing costs. A dollar facing reduced global demand imports inflation, because a currency the world needs less is a currency that buys less. The consequences are not theoretical, and they are not distant. They are already beginning to show up in the data if you know where to look. Which brings us to gold, and specifically to a price move that deserves far more attention than it has received. Gold crossed $4,000 per ounce in October 2025. Think about what that number represents for a moment. At the start of 2024, gold was trading around $2,000. That means, in roughly 18 months, the metal that central banks around the world have been accumulating at unprecedented pace doubled in price. A 55% gain in 2025 alone, making it one of the single best performing assets on the planet during a period when most American investors were focused on tech stocks and Fed pivot speculation. And here's what should really focus your attention. This wasn't a speculative bubble driven by retail investors piling in on social media tips. The World Gold Council's data shows clearly that the primary buyers driving this move were institutional. Central banks absorbing over 1,000 tons per year, sovereign wealth funds quietly repositioning, and large asset managers at institutions like JP Morgan revising their price models upward as the structural demand picture became undeniable. JP Morgan's commodities research team, not a fringe newsletter, not an internet personality, one of the largest and most sophisticated financial institutions on earth, has published a price target of $5,000 per ounce by the fourth quarter of 2026. Their reasoning is not mystical, it's mechanical. When you model the rate at which central banks are absorbing annual gold supply, overlay the declining share of dollars in global foreign exchange reserves as tracked by the IMF's COFIR data, and account for the structural shift away from treasury bonds as a reserve asset, $5,000 is not an aggressive call. It is, in JP Morgan's framing, the mathematically expected destination given current trajectories. Let me put that in terms of what it means if you'd been paying attention 12 months ago versus waiting for mainstream consensus. An investor who allocated even a modest 10% of a $280,000 portfolio to gold in early 2024 would be sitting on gains that significantly outpaced virtually every traditional dollar-denominated asset over the same period. The information to make that decision was available. The institutional signals were visible. What was missing for most people was the connective tissue, the story explaining why these things were happening and where they were heading. That connective tissue is what we've been building together through this entire video. Now, I want to be very direct about something, because I think clarity matters more than drama here. What we are describing is not a 2026 crisis. It is not a sudden cinematic dollar collapse where ATMs stop working and grocery shelves go empty. The people who frame it that way are either catastrophizing for clicks or genuinely misunderstanding how reserve currency transitions work historically. What history actually shows, from the British pound's transition out of reserve status across the mid-20th century from the Dutch guilder before that, is that these shifts unfold over a decade or more. They are gradual, they are uneven, and they are almost invisible from inside them until suddenly the repricing that's been building for years arrives in one sharp, undeniable move. The pound didn't collapse in a day. It eroded across decades, and then one morning in 1967, the British government was forced into a humiliating devaluation that made the new reality impossible to ignore. The decade-long repricing of the dollar's global role has already started. The evidence we've walked through, the expired petrodollar agreement, the operational bridge platform, the 3 consecutive years of record central bank gold buying, the BRICS unit pilot backed by gold, the structural retreat of dollar assets in global reserves, that's not a prediction. That is the documented record of what has already happened. Here's what that means practically for you, and I want to leave you with this because it's genuinely empowering rather than frightening once you see it clearly. We are still early. That's the crucial point. The mainstream financial press is not running daily coverage of bridge. Your broker is probably not walking you through the implications of the petrodollar expiration in your quarterly review. The moment when every financial channel is leading with dollar-losing reserve status. That's the moment when gold is at $7,000 and the easy money has already been made. We are not there. We are in the middle of the setup, which is exactly where informed, attentive people have always had their greatest advantage. The Americans who built generational wealth through previous monetary transitions weren't the ones who waited for Walter Cronkite to tell them it was official. They were the ones who read the signals, understood the architecture, and positioned themselves, while prices still reflected yesterday's reality rather than tomorrow's. What we've covered in this video is the foundation of that positioning decision. The petrodollar was a secret deal that held the world's dollar demand in place for 50 years. That deal has expired. The replacement infrastructure, digital payment rails, gold-backed settlement instruments, bilateral currency agreements, is being assembled in real time by nations controlling a significant share of global GDP and energy supply. The mathematical consequence for American borrowing costs, inflation, and the purchasing power of dollar savings is already computable, and it runs in one direction. Gold at $4,000 is not the end of this story. It is the first clear chapter of a much longer repricing that central banks, the most conservative, most data-driven financial institutions on the planet, have already voted on with their balance sheets. The question for every American watching this video is a simple one. Are you going to wait for official confirmation, or are you going to think like the institutions that are already 3 moves ahead? The information is in front of you. The decision, as always, is yours.